Futures are up. Look at that. And we got Paul Hickey on, who probably isn't totally surprised. Bespoke Investment Group co-founder. You point out that the last couple of times you're on, when it's front and center, right in front of your face, all the scary things, that's usually a pretty good time to either stay in or buy.
Yeah, so when I was on last time in April, we could have talked the entire hour about every reason why the market should be going down. But we were already down 20% or close to it.
Yeah.
So, I mean, in that fact, the worst of the news was already priced in. And at that point, we were already starting to see negative headlines and the markets starting to recover and rally. If you looked at the headlines of the lead New York Times headline every day in the month from the low on, you would have thought we were going to be in a cataclysm.
It's still like that.
Yes, and then the market kept rallying. So the signal is no matter how good you think the models are, you got to listen to the signals, what the market is telling you. And at that point, and during the second half of April, as bad as the news was, the market was starting to look past that and say the worst was behind us.
It probably won't happen today. Maybe if things really got going, with positive sentiment, the S&P could trade at an all-time high today. Now what's the market telling?
Well, so this is really interesting. So we've had this big recovery. So now you say, okay, well, we have to trade sideways or have some give back. But if you look historically, these 2-month rallies where you've seen a 20% gain, what you've historically seen is it's been more the beginning of the rally than the end of it. The median gain over the next year after the 10 prior times where we've seen this big a gain in a 2-month period was 23%. And most of those periods came, and we were still well off 52-week lows. So what's slightly different now is we're near 52-week lows. But in 82, we were within 3% of a 52-week high at that time. In 91, we were within, we were right at a 52-week high. And then the 98, we were within 2 or 3% of a new high. And the market kept going from those periods. So, I think you can still say there's more gains ahead here as we look to the second half in an environment where we're potentially likely seeing inflation not materialize to what everyone's been looking for, and that could set the stage for the Fed to cut rates for good reasons rather than bad.
Right. I guess the easiest thing to think is that, okay, we had the tariff scare, we had some other things. So we went down 20%, but now we're just back to where we were, but there's really no reason to go higher from here. That's the easiest thing to think. Your view is that not only do we match the old highs, but that it continues from there. So do the tailwinds of some of the things that business people were excited about in January before the tariffs, do those start?
Yeah, so I mean, one of our favorite sectors coming into the year was industrials, on the idea that we're going to see more activity come to the U.S. and regulations get rolled back. So these projects would get done quicker and quicker in the approval. So that we're starting to see. If we see the tax bill, we don't know what the final look of it is, but the tax cuts from 2017 I don't think are going to expire completely. So we'll see something pass there, depending the final details are still, we'll wait to see. But I think in that respect, you have that. And look at this. Oil prices are down on the year. Look what we've seen going on in the Middle East, and oil prices are down on the year. That's unheard of. And that, as bad as the higher tariffs may be as an inflationary impact, lower oil prices are a big tailwind for lower inflation and lower inflation rates. So that could be a tailwind going into the second half of the year. And I think the key here, two things to watch, is we go into today, very good news. The market has, futures are higher. We've seen a buy the dip mentality in the market, one of the strongest periods where the market from the open to close, going back to 1993, the performance of the market during those trading hours has been among the strongest we've seen. If we see that follow through, even on a strong day, I think that's something to watch. And then earnings season coming ahead, that's the one thing we're watching here as a potential headwind, because sentiment heading into this earnings season is much less negative than it was last earnings season. And that's last earnings season, we had a very low bar for the reports, and we saw that bar get exceeded quite easily.
So the tariffs that we have right now, I mean, we have the pause is going to expire on some of the tariffs. Do you expect do you expect deals to be made so that they don't eventually be put in? Is this as bad as it's going to get? And with what we have now, whatever you calculate it as, it's more than it was, but is that enough to cause inflation that's not offset by the decline in oil prices?
So 14% of the U.S. economy is imports. So, the April 2nd levels of tariffs are not going to be seen, in my opinion. I think Trump has seen that. There's been some bluster, and we've gotten some, we've gotten some give back from trading partners, and we're going to see that. I don't think we're going to see a complete reversal, and we're going to continue to see things get extended. And as far as the tariff impact on inflation, it reminds me of this. Have you ever seen this at a bar? It says free beer tomorrow, right? So tariffs is always a tomorrow thing. What we're seeing with inflation, we're seeing tariffs are going to cause inflation. Next inflation report, and then the inflation doesn't materialize, and then the next inflation report. So if we get the June CPI report come in and we don't see this inflationary impact of tariffs come through, I don't think the Fed's really going to have much of a leg to stand on to say we still have to wait and see what's going on and what's the impact is going to be. It's going to be 3 months of tariffs, tariff policy in effect, and very little impact on inflation.
You brought in that prop? You brought in a prop?
Yeah, you always,
you
always have to be prepared.
Brought in that prop.
Yes.
I like beer.
Yeah, beer is very good. Tariffs, inflation is not good.
Homer? No, that was Brett Kavanaugh, actually.
But, so, I mean, I think you can't keep saying something's going to happen tomorrow and keep pushing it off. Eventually, you have to say, okay, we're not seeing it come through.